What?
What's the value for Lehman before it went bankrupt?
Whatever it's similar to Citibank. Whatever Lehman was earning in 2006, if Lehman would exist today, I'm sure they were going to earn the same thing in 2012. But because they didn't have a strong balance sheet, they got...
No financial company has a strong balance sheet.
Then why invest? There's 1,000 different companies out there.
I think comparatively they're different.
Because you would think that Wall Street still exists.
Well, most of those bankers and the analysts and people probably went on to get jobs on Wall Street, just in a different firm. Right? They're doing the same thing. Again, just under a different name. They're working for Barclays now, or some hedge fund, or JP Morgan, or they have their own startup.
You can just bet on all of them by buying ETF, and if one of them go up.
Yeah, it was a legitimate strategy to buy a regional bank or a major money center bank ETF back in 2008. It was a regional strategy in September 2008, and it became more reasonable in December 2009 or December 2008, and probably very reasonable in March 2009. But again, the problem, and those guys investing in AIG and Citibank, they're probably right. They're probably going to make good money. He's a very good money manager, with very good instincts. It's probably the right time to if you were going to buy financials, this is probably the right time to do it. Because if you don't think we're going to have another double dip, everyone's pretty depressed right now. Everyone's pretty skeptical of lending money. Ironically, that's the best time, because the book of business is probably better now than it was. Your loan portfolio is probably better now, because the loans that you've made in the last 12 months are probably tighter underwriting and less risk, right?
So you don't wait until the fundamentals to improve.
That's smart.
Yeah, that's true. I agree with you, because if you wait, it's usually too late.
Right.
Usually too late. But do you wait for the price to firm up, or you try to buy after the drop?
I probably buy too early, and then I buy. Obviously, the first semblance of a problem starts to show up. That's why there's a weakening in the valuation, and invariably it drops more. Like I've owned Seco for 5 years now. I bought it when they had a terrible management team, probably starting in their high 20s, low 30s. Rode it all the way down to 11 when they brought in a new management team, and it's taken 5 years. So, and part of that was luck, because a friend of mine went on the board, and he's such a good capital allocator that from the capital allocation point of view that they're going to do a good job, and so that helped out a lot in terms of buying back shares and having faith. And also, he brought in, he had some input into who they chose as CEO, and the CEO is very impressive. And he looks at things the right way. He looks at student outcomes. And if you have a happy customer and you keep your employees happy, then generally, you have you usually add shareholder value over time. Not always true. Like the airline business is not really true, or the oil making business is not true. In certain businesses, that's true. So if you take care of your customers and you take care of your employees, usually the shareholders work it out. And I think this management team understands that, and they're pretty impressed with that. So, and it was very dynamic. There was a while there when it was really a poorly managed company. Now it's one of the best managed companies I own.
So operationally, you tend to buy at the new low price?
Well, my initial position tends to be on the lower side, and then I'll probably keep on adding.
Adding up when the price firms up?
When it keeps on going down.
Keeps going down?
Yeah, I probably don't buy on the way up.
So you tend to buy at the first half of the green bar? And
then the other shoe drops. Yeah, I buy when the first shoe drops, and then the other shoe drops because I missed something, and then I buy more when the other shoe drops. But I don't buy it when it goes out. Generally, I don't buy it.
You generally don't buy on the way up?
No, because I'm spoiled. I already got the low price. My bias is like, I could have bought it at 8 last year. Why am I buying it at 12 this year? Even though it's worth 20, and you rationally should buy it at 12. I do have a bias thing. I was already spoiled on.
There are some operators that they think majority of the position should be bought on the way up. Like they buy a testing position while seeing it down, and then when they see things get better, they pile up. What do you think of that theory?
I'm glad they can do it. It probably makes a lot of sense. I wish I could do it. They'd probably be it's a good skill to have. I mean, we all have biases. That's part of this business. You're talking about you know, you can't get rid of your losses because you have a bias against cutting your losses. You know, again, being a value investor is, or just being an investor, whatever discipline you choose in investing, it's about your makeup. It's not about intelligence. It's about how your willingness to understand the difference between price and value, and more importantly, your willingness to delay your gratification and not worry about quarter-to-quarter performance or even year-to-year performance, as long as you're confident in your ability to assess the value of your portfolio holdings on a per-share basis and continuing to increase over time.
Can you talk about your best stock in your investment career?
Probably there are two of them. Network Associates went from 3 to 20, the one I described to you earlier. In 2001, I have a buddy of mine who was investing in Korea, and he told me which companies to buy in Korea. So none of this is my idea. I just copied it. He told me about a cosmetic company called Amore Pacific back in 2001, and I bought the stock at 27. And now they have like $40 a share in cash, so it's way above what I bought it at, and they're probably earning $40 per share now. So I bought it at less than 1 time. 10 years. If I could offer a U.S. stock now that has like trading at like 10 times earnings, but in a decade, in 2020, you would be buying it at less than 1 time that year's earnings, you'd buy it now, right? I mean, again, you're going to be get paid. You get delayed gratification, but in 10 years, you'll be getting paid 100% of your original investment. Plus, it's still growing at 10% a year. So, those are probably my 2 best investments.
Network Associate?
Yeah, that was in 2001. It was an antivirus company. I bought it at 3. It went up to, because you know, I knew the business because I was short Network Associates before. I knew that the operating margins are should be 30%, and the analysts the Wall Street had it at 0 for the next year or so because they were going through a restructure. So.
Did you take a look at the Boston Scientific?
Not very heavily, no. Yeah.
I'm not sure how relevant it is, but I'm just curious. If at all, how does options writing fit in? Because I'm just thinking, part of me thinks that if you're willing to commit because you see upside potential, why not write the covered call, get a small premium in case you're not 100% right, but then again, you may not do it because you don't want to give it up early.
I only do covered call options in the very specific. I do covered calls.
Okay.
Only on the very specific situations when a stock is trading close to my fair value and I'm about to go long term on it. And if I'm like 2 or 3 months away from going long term, then I'll write a covered call against it just to make sure other income from it. And usually, invariably, the stock goes past the strike price, and I end up with a loss on the option and a long term gain on the stock. The other opposite is, and I know friends who do this. I would never do. I've done this 10 years ago, but I would never. I would generally not do it anymore, and never do this on a financial. Repeat, never do this. Never sell a put on a financial company. Okay, you sell a put, you collect a premium, and you think you're buying the stock at a lower price. I can see where you would do that on certain cash-rich companies, like a software company or a service company, like Google. Like if you could have you could have sold a put on Google. Let's say you go 12 months out, and the stock's trading at 250. You sell a put at 250, you probably could have collected $30 in premiums. So your 190 price was effectively 160, and 140 a year later because they would collect another $20 on the balance sheet. So I can see logic for doing it for that. Okay, but let's say if you sold a put on Lehman, you're done. That's game over, right? Because Lehman is trading, or let's say you bought, let's say that Friday before Bear Stearns was sold at $2 on Sunday evening, even though it eventually sold at 10. You sold a put at 25 or 20, and you thought you were brilliant because you got $1 for it, and then you only had to wait a week. Well, guess what? You're bankrupt. You're bankrupt on Monday morning. Game over, right? So you never want to sell a put on financial because